Module 25 for the Series 65-66 class, presented by Series 7 Specialist. I'm Dan Mars, your instructor. Glad to have you back, and glad to be talking to you about this. We hope that we're a vital element in you passing the test and in your success, as do all of our sponsors. So be sure to visit our sponsors. They really appreciate it, and so do we. Let's go ahead and pick back up, though, with page 38. About the middle is where we were. We were talking about different measurements and quantitative measurements, and one of the things that we mentioned is that you don't necessarily have to calculate these things as much as you do understand what it is that they measure and how it is that they're used. So just getting a good grasp on essentially what it is, how they fit into the scheme of things, what types of measurements they use or statistical indicators they use to give us the quantitative measurements that you'll need to see on the test. So inflation adjusted or real rate of return is where we need to pick up, and basically what that is, you just back out the inflation rate from the raw rate of return, and that gives you your inflation adjusted or real rate of return. So in other words, if I'm producing 10%, but I've got 7% inflation, then 7% of my return is eaten up by inflation. I'm only getting a rate of return of a real return of 3%. That's my real growth, because the rest of it is just, like I said, it's inflated into the return number. So that's our inflation adjusted or real rate of return. After-tax return is pretty self-explanatory. You net out the taxes. If I make $100, but 60 of it has to go to various taxing authorities, I'm only netting 40, and so that's going to be my after-tax rate of return, and it's usually used when comparing municipal bonds to other investments that are taxable. And I doubt very seriously that you're going to have to do the math on that. But basically, one of the things that you can do is just to kind of box it out like we've done before. Like I said at the very top, my artwork isn't real good, but sometimes it gets the job done. And really that's all you need to do is give yourself a mental picture. So that if I have a taxable return, I stack up the dollar bills and there they are. I want to compare that to a tax-free rate of return of this much. Just on the surface, it looks like this one is going to be, nah, there's no way. This is better because I get more dollar bills stacked up. But the thing about it is, if I compare my after-tax rate of return, and that's right across here because this is tax, and that's that I keep. But here, I keep it all. Which one's better now? Yeah, it's the one with the higher after-tax rate of return. And we'll do that a lot. We'll compare, like for instance, municipal bonds to corporate bonds or treasuries. All right, so anyway, there's the after-tax rate of return, and then the risk-adjusted rate of return. What we do on this is that we divide our raw numbers by beta. Now we've got to go down a couple of lines and pick up beta. Okay, beta is the volatility of something, okay, compared to something else. And so basically what we have is that we have the S&P 500 has a beta of 1. So what I'm going to do is that let's just draw this out, okay? And the risk measured in volatility, we said that earlier, that's one of the numerical indicators of risk is how volatile an investment is, because I may need to sell it, and if it swings fairly wildly, well, yeah, I may need to sell it up here at one of the peaks, but I may need to sell it down here on one of the troughs as well, and that's risk to have to do that. So if my S&P 500, which has a beta of 1, and it does like so, all right? Now, we could compare that to a tech stock, for instance, which has a beta of 2. What's going to happen is that when I move this much on the S&P 500 with a beta of 1, then I'll need to move that much, twice as much, so my tech stock will actually look more like that. Or I could compare it to, let's say, a utility, which has a beta of 0.5. Okay? That means it's going to have half of that fluctuation. So I'm going to have like so. Now, if each of these return 10%, my risk-adjusted rate of return would be 10%, because I'd be dividing by 1, 10% divided by, it is itself, and therefore, like I say, if you have a beta of 1, then your risk-adjusted return and your raw return are the same thing. But the thing about it is, up here with my tech stock, I have a beta of 2. So I had to make twice as much risk to get the same return. Wait a minute, I'm only going to have a 5% risk-adjusted rate of return up here because I had to go through all those gyrations. Conversely, if I go with the utility stock that has, and by the way, this is just utilities typically are less volatile than other stocks. Tech stocks generally more volatile, and that's the only reason I have them. This isn't a recommendation or anything like that. But what I've got it, and you're not going to have a situation, or you probably won't, where you have 10% on all three. But if you did, okay, remember the test has to provide kind of a laboratory for us. If you did, then really, with only half the volatility, my risk-adjusted rate of return would be 20%. That's what I'd have to get on the S&P in order to have that low of volatility, that low of beta, and get 10%. So in any event, the important thing really is to keep in mind what you have on your outline. That if your beta is above 1, then your risk-adjusted return is going to be lower than the raw rate of return. If your beta is below 1, that thing moves inside a tiny little band, then your risk-adjusted return is going to be higher than your raw rate of return. And a lot of times just keeping that in mind is all you need to know, because there's not a whole lot of math on this thing. And so that's one of the reasons why I use round numbers when I illustrate this, is it's kind of easy to keep track of. All right, the risk premium is the expected return that you're going to pick up from taking a higher risk. Now, one of the things that you have is that, of course, there are, again, several ways of measuring risk. One of the ways of measuring risk-free is by looking at the 90-day T-bill. And so basically what we have here is that there is a risk-free return So this is what the 90-day T-bills are yielding. But I have an expected return. Remember, I take those probabilities, the best case, the worst case, the medium, and multiply out by the probability, by the rate of return, add those together. And this is my total expected return. Okay? But if I can get this from a risk-free investment, then this means that is my risk premium. I'm being rewarded this much, that top box, for taking a risk versus just putting it in something where I know 90 days from now I'll get my money back at a reasonable rate of return, the risk-free return. So that's our risk premium that we're talking about, is the additional return that we expect from taking risk. Now, opportunity cost, all right? We can use this same thing. Because, see, now we flip it around backwards, and if I decide that I'm going to put that in the risk-free, then that means that I'm going to get this much, okay? However, I could have put it in the riskier environment, and if I had put it in the riskier environment, I would have earned that much. This, not only, it's my risk premium over here when I decide to take it. When I decide not to take it, it's my opportunity cost, because I could have had that, but I decide not to take the risk. So they're mirror images of each other. One where I take it, one where I decide not. Then I have the risk premium from doing so, or I have the opportunity cost from not. Let's look at those risk measurements. And in fact, there we go. We start out with beta, so we can kind of skim over it. It's the volatility of a stock or portfolio compared to the market. So the S&P 500 has a beta of 1. Now, it's important because you've got beta and you've got standard deviation. Those are both measurements of volatility. Beta is the volatility of something compared to. Standard deviation is the volatility of something. Period. That's it. End of sentence. Okay? So, everything is going to have some volatility. It's just how much is it compared to the market? That's going to be your beta. Your standard deviation, that's going to be how much volatility it has on its own. And so what we've got is a situation where I tried to forget everything I could from statistics, but some of it kind of sticks. So anyway, there we go. Everything generally falls into a bell curve. And so what you've got is a situation like this, that if you have that utility, your bell curve is going to look like so. Your observations of return are going to be like so. If you have the S&P 500, then it's going to look more like so. If you have the tech stock, then it's going to look more like so. Each one of these curves has like 3 standard deviations plus or minus that have, you know, almost all of the observations of what you'll see once you record what happened. And so the smaller the standard deviation, then the lower the volatility is. The bigger the standard deviation, the more the volatility is. All right. So like I said, it just measures the standard deviation. Just measures the volatility of something on its own volatility measure. So if you have greater volatility, a bigger standard deviation, you have greater risks, you have less predictability of returns. You have the R squared or correlation factors, which ranges from 0 to 100, and 0 R squared or 0 correlation, it's a spurious factor. It's Tuesday, therefore it's raining. Wait a minute. No, it has, over a long period of time, there's just as much chance of getting rain on any other day than there is on a Tuesday. The fact that it's Tuesday and it's raining have nothing to do with each other. All right? Let's see. There is water coming from the sky, therefore the sidewalk's going to get wet from the rain. There we go. That's going to happen, all right? We know it's going to happen. And so that's going to be 100. So anyway, like I said, the correlation factor, either no relationship at all, 0, or 100 is going to be a 100% direct correlation. The one happens, so does the other. You have either a causal effect where one causes the other, or it's coincident all the time. So in any event, let's see, we've got, then we have duration. We've mentioned duration several times. Duration's kind of a strange little bird because it's measured in years, but it's not maturity. Maturity is not the same thing. Technically speaking, it's how long it takes you to get your money back out of a fixed income investment. But here's the way that I like to look at it. If it's true that the maturity on a 0 coupon bond is equal to its duration, which that is true, okay, then basically what happens is that as you pay out money off of that bond, your duration is going to shorten up and shorten up. And duration actually can measure volatility, because if I have a bond portfolio with a duration of 7 years, now I may have some 10-year, some 15-year bonds in there. The average maturity might be 11 and a half years, but the way it's going to act in the marketplace with regard to volatility when interest rates change is going to be like a 7-year 0. All right? Now, the longer maturity you get with a 0 coupon bond, actually with any kind of bond, but particularly with a 0 coupon, the longer the maturity, the greater the volatility. Okay? So it's very similar to just taking your pen and flipping it up and down between your fingers, okay? Basically what I've got is that if I have this much time to maturity, then I've got, give me a change in interest rates, and I'm going to have a pretty big change in price. But if I flip it around the other way, and I only have this much till maturity, very short time, I'm flipping it the same way, but oh look, it's very tight little price moves. All right, it makes a real good visual for you that you can actually do there in the testing center. All right, so like I say, the shorter the duration, less the volatility that you have. And like I say, the more that the money is more money is getting paid out of the bond portfolio, the shorter that duration is going to be. All right, so that's duration. Convexity, it measures bond prices' sensitivity to interest rates moves, and it's used in measuring the price volatility of bonds. Just knowing that, okay, it's probably going to be enough for you. It'll be probably definitional, because that really does get into some complex calculations. Valuation ratios that we have price to earnings ratio, or PE ratio, or market multiple. Now, here's the deal, okay? At one time, in fact, we had referred earlier to when the dot-com companies were just, it was a frenzy, all right? And there was this one company that I was working with somebody, and she got some stock in a divorce, and she said, what do I do with it? I don't know. And so I said, well, let me look at these things and see. And so I did this with that, something else. And I said, now this one, I said, you know, it's gone up very, very significantly. But let me put it in perspective for you, okay? It has a 952 price-earnings ratio. She said, what does that mean? I said, let's say we bought the whole thing. The whole thing, okay? And nothing changed from today. Every year we made the same amount of money, every year, nothing changed. She said, okay. Do you know how long it'd take you to pay back your purchase price? She said, no. I said, 952 years. And she said, that sounds a little expensive to me. It's like, I think so. I'm glad you said that. And sure enough, very shortly after that was when the bubble popped, and so we were able to preserve that money from her just by looking at the multiple that the market was putting on. It did have earnings. Got to give it that much. But like I say, it was just it was running to the ridiculous side. So in any event, typically, if you have a high growth situation, that's going to demand a higher market multiple. Because, why? Because we know that next year things don't stay constant. And if we have $1 of earnings, well, next year we're liable to have $1.50, and the next year $2.25. Well, my goodness, now if I apply that same multiple, that thing, see, it's going on up. If you have a more stable industry, more stable stock, they've earned $1.23 for each of the last 14 years. You're going to have a very low price-earnings ratio. Why? You're not going to have that expansion of earnings like you do in a high-growth situation. So, what's expensive? You know, what's cheap? A lot of it is relative. I mean, from time to time, you'll see something that really is. It kind of speaks on its own. 952. That's, unless there are some really big extenuating circumstances, that's pretty high. Okay. But well, again, you got to compare to the industry. You've got to look at the outlook for that company, and that's the way that the market. Remember, we said that the market discounts or takes into account all of the factors that it can. That's one of the ways that it does that, is through putting a higher PE on higher expected growth, lower PE on lower expected growth. Okay, so like I say, it's lower with the value stocks. Value stocks are where the asset values are undervalued. That's why we buy them. Is that one of these days we know that, well, we're hoping anyway, that the rest of the market will recognize that what they own is worth a whole lot more than they're going for right now in the marketplace. And typically you're going to have lower PEs with value stocks or stocks in mature industries, higher PEs, higher risk, higher return. Because what happens if there's a surprise, if it's a pleasant surprise, then, oh, wait a minute, what are we going to do? We're going to take that pleasant surprise. You know, if we've got a 50 price-earnings ratio, we were expecting whatever this is in earnings, but we actually got that much, we're going to take this and multiply it by times 50, boom. I mean, that's a kick to the stock. Real good one. But it's always a two-edged sword. If we're expecting this in earnings and we have an earnings disappointment, then we're likely to see a reaction to that disappointment to the tune of 50. See? Now, if we had a 3 price-earnings ratio, you wouldn't get the kick with a pleasant surprise. You wouldn't get the punishment, really, with the unpleasant surprise. So, like I say, that's something to keep in mind there on price-earnings ratios. And then price-to-book ratio. Book value is the theoretical liquidation value of a company. And price-to-book is most often used with financial companies or with companies that a lot of their assets are things that they don't produce the way that production equipment does, or the way that even real estate or storefronts do. And so financial services companies, banks, brokerage firms, insurance companies, price to book is going to be pretty important, okay, other financial companies. But that's basically the market price divided by the theoretical breakup value of a company. And we kind of talked about that earlier when we said that you take all the assets, okay, and then what do? You go over to the liability side of the balance sheet. You pay off all the bills, the current liabilities. You drop down, you pay off all the long-term debt. You look at the stack of dollars that are left, and you've got fluffy stuff, intangibles, goodwill. I mean, you can't sell goodwill. You throw it away, okay? And then what do? You divide that by, well, first of all, you pay off the preferred shareholders, and then divide whatever's left over by the number of common shares. That's going to be your book value. Whatever your price is compared to that, then that's your price to book. Again, most commonly used with financial companies. I noticed one time that at the moment, Walmart was it had a book value of, and I could be way wrong, but it's a concept that's important. It had a book value about $7, $8, somewhere out there. May have been as high as $13, I don't know. The price was in the 40s, 50s, somewhere like there. Yeah, we really don't care what the breakup value of Walmart is. You know, we care how many tricycles and tubes of toothpaste they sell, how much money they can make on the t-shirts and the things that they sell. Okay, that's what we worry about with Walmart. But financial companies are a little bit different. All right, so we'll go ahead and stop here for now, and then we'll come back in the next module, start picking up more comparisons.